There's a huge debate about whether central banks should be in the business. When you go back to 99, should central banks be in the business of popping bubbles, or should they be in the business of cleaning up the mess afterwards?
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
James Mackintosh, welcome.
Hi, glad to be here.
You've been at the Wall Street Journal now for about 5 years, and before that, 20 years at the Financial Times.
Yeah, that's right.
Right, and most of the writing that I've seen from you, I've been reading you for quite a while here, has been around the markets, the economy, and the part that I generally gravitate to is investor psychology or market psychology, economic psychology. I'm curious as to kick it off to get an understanding of why this is, maybe what is interesting to you among those different topics I just threw out, and why you've been writing about these topics for so long.
Well, I love the puzzle that is markets. It's just fascinating. It's endlessly fascinating. There's always a new thing to try and fit together. There's never really an absolutely right answer, or if there is, you don't know for sure you've got it. And everyone disagrees, of course, because it always takes two views to make a market. And so it's endlessly fascinating, and that's why I'm interested in it and why I write about it. And of course, the things that drive markets, the things that make them go up and down, are fundamentals and psychology. So I'm of course interested in the fundamentals, which include kind of the economics, but also structural issues around markets and makeup of the companies involved and all these sorts of things. And then the investor psychology, which my personal background is in both economics and in psychology at an academic level. I wouldn't say that anything that I learned at university is in any way useful, but it does reflect my interest. So the two aspects of this really are fundamentals and psychology. And if you're going to have any hope of trying to piece together the market puzzle, you've got to look at both.
We've talked about that a lot, and I'm going to oversimplify a bit, but so Skippy and I have two different styles of investing for our own personal portfolios. He goes much more deep value. I do what I call long trend momentum, where I look at momentum over long periods of time. And the oversimplification is I often say that my investing is much more based on the psychology of the markets. His is much more in the fundamentals of the markets. Neither one is pure in that way, but it is it's interesting to look at both of those takes. Fully agree.
Yeah, although I might flip it the other way and say that deep value is the only reason deep value works is psychology, because the reason something gets to be deep value is fear of an excessive fear of the bad outcomes. So you could argue it the other way around. But yeah.
Douglas, I'm with James on this one. That's actually my take. And when you talk, Ben Graham and deep value, it's kind of, that's what helps me sleep well at night is mean reversion and everything else. So I'm with James on that one. James, I went to business school in Europe, and it's so funny. I didn't even think about this until we started talking to you, but at that time there was a debate in my business school about the Financial Times and the Wall Street Journal, and I just realized you've worked at both those institutions. Are they similar? Are they different? Can you compare and contrast writing at those two premier financial journals?
Yeah, I mean, there's a lot of similarities. I mean, the similarity, of course, the deep similarity is both papers want to get to the truth and invest their resources in trying to do that. I mean, there's obviously quite a lot of cultural differences between the two, not least that as a Brit, I of course find it very, very hard to write in American, so I'm constantly having to twist my sentences to avoid using words that jar in my ears. But yeah, I think the deep similarities are stronger than the differences, and most of the differences are things that would would be hard to explain to non-journalists. They're about the structure of the journalism and the type of approach, rather than necessarily the outcomes.
Thank you for that. So, James, there's many reasons to have you on, and I'm sure we'll love talking to you because I think you're just a wealth of information and expertise as it relates to the markets. The reason for the show is very similar to the reason you're a journalist. We just find it endlessly fascinating and think it's fun to debate. The article that really caught our eye recently, although Douglas and I both pretty much read all your stuff, I think, came out September.
You can feel free to buy like 2 copies of the paper to ensure you've really got it.
Hey, does the digital subscription work? Because I'm currently a digital subscription. I need to know if I should switch over to help you guys out.
Yeah.
So there's an article that came out on September 8th. It's called "Digital Currencies Pave the Way for Deeply Negative Interest Rates." I think this is just fascinating. I think it's so good, but it's also pretty complex. So we were thinking we'd try and walk through point by point with you to establish kind of why interest rates are important, how they tie to bonds, the foundational stuff. We'll pretend we have a third grader listening or something, and then talk about some of the nuance and some of the interesting aspects around, if you assume this hypothesis is true, where that leads. So could you start us off with some foundational
the absolute basic here is, what is a central bank digital currency? And of course, you hear digital currency, you think Bitcoin. This isn't Bitcoin. This is electronic money. So in that sense, it's got a parallel to Bitcoin, but issued by a central bank. Now, there's very few that do this at the moment. There's a couple that are experimenting. There's a couple that have moved on beyond the experimental stage, China and in the Caribbean as well. But they're not really, they haven't really hit in a big way yet. But all the big central banks are working on it. And what it will look like is probably some sort of app on your phone. It's a bit like a bank account, but held with the central bank. So you'll have a bank account at the Fed. It's much more likely to be like that than it is to be like Bitcoin. So it's just possible that there'll be blockchain involved, but ultimately you as a consumer wouldn't need to know that. It wouldn't matter in the same way it does with something like Bitcoin. So it's much more likely to look to you or look to us like a bank account, but instead of being a bank account with JP Morgan or with any of the mainstream banks or your little local bank, it'll be at the Fed or at the Bank of England or at the European Central Bank. The reason that really matters is, of course, they can't go bust. So there is no risk to this. This will be the safest form of money. But in the long run, the expectation is that physical banknotes will wither away. So you'll have this instead. So the idea is this will be something you can use instead of a physical banknote. And technologically, there's a huge amount that's still unknown because most of the decisions are still to be made. It could be that you'll be able to transfer money from me to you without anyone else knowing about it from this.
Yes.
So in that sense, that would be somewhat different to a bank account at JP Morgan. But it would be, we don't know if that's the case. We don't know if that'll happen at all. But that would make it much more like physical cash if they did allow that. We don't know what will happen if you lose it. Will it be like physical cash that it's just gone? You lost it, hey, tough. Or will it be, you get hacked, hey, tough. Or will it be that, that sort of thing happens, you can go to the central bank, just as you can go to your bank and say, hey, something went wrong, can I get a refund? And, JP Morgan might say no, but it's well within their capability to give you one if they chose, in a way that it isn't obviously for physical cash. So there are similarities, there are differences. The reason it really matters is that at some point in the long term, of course, this thing is likely to pay interest. Now, I suspect when it first starts, it won't pay interest. It'll be like cash. It'll probably be capped, so you can probably only hold, well, we don't know, maybe a few $100, maybe a few $1,000. We don't know where the limit will be, but there'll be some sort of limit, at least to start with. In the long run, that limit might or might not survive. We don't know. The important thing that comes out of all of this is there's a lot we still don't know, because that nobody knows, because the decisions genuinely haven't been made yet by the central banks themselves, and by in some cases, governments will have to pass laws to allow this. And in the short run, it won't have any impact really on anything very much, because it'll run in parallel to physical cash. Yeah. And here's where it gets really interesting. So do you believe that once they've got this, that in the long run, physical cash will survive? Well, already, if you look at the countries that are furthest ahead, Sweden's probably the furthest ahead in the world on the loss of physical cash. Almost no one uses physical cash. Like, what's it for? You can pay absolutely everywhere with your Visa or MasterCard, and you just don't need physical cash. And that's one reason Sweden has been pushing hardest to do some form of digital currency, central bank digital currency, because Sweden's really worried about handing over its entire payments mechanism to a couple of very large global monopolies, or duopoly in this case. It's bothered about that. It thinks there should be a public sector alternative. So if I want to pay you, a cut of that doesn't have to go to someone in the financial services industry. The central bank can provide it.
So I was going to jump in there and reset, because I think this is the first foundational block. So I think it's reasonable to assume that this is the way a lot of governments will head towards digital currency. I think your point around, if that is blockchain based, obviously if it's government based, it won't be a decentralized currency like a Bitcoin, but it could be blockchain based. It could be non-blockchain based. It could be like PayPal or JP Morgan or whatever. And then when that runs in parallel with physical cash, I think it's also reasonable to assume that at some point, I don't know if that's 5 years or 30 years, you move to a point where you're almost a cashless society. I think that's kind of foundational block one here.
Yeah, exactly. And I think at some point, once you get to that point, once you get to the point which Sweden is already approaching, and indeed other places are moving that way, where you actually can't use cash, the shops refuse to accept it. If you start moving that way, then at some point, society at large says, well, what's the point? Why are we wasting all this money printing physical banknotes that nobody uses, or nobody can use, and they just, all these coins that sit down the back of the sofa? What's the point? We're quite happy with this. And I think once everyone gets used to this idea, and whether it feels like a bank account or it feels perhaps like a QR code, the Chinese financial system has shifted to operating primarily with QR codes at a retail level for payments. Whatever system it is that it moves to, I think we'll probably all get comfortable with that, and then we'll just start saying, why are we wasting all this money printing banknotes that nobody wants or uses? And certainly from the point of view of the central bank and the government, it's much more efficient if they can get rid of them, because it's quite, whilst economically in the grand scheme of things, it's not that big a deal. It is still a cost.
What is the importance of physical cash specifically, and its relation to the economy and interest rates versus digital?
Yeah, so we'll say here, what really interests me about all of this, and the reason I was writing about it in the first place, is the potential implication for monetary policy, which is the really interesting thing here. There are also some other things that I don't know if you want to get into about bank stability and bank runs and the like, but the thing in this particular article I was focusing on was monetary policy. And the reason it matters is that if you have negative interest rates, so what you would do, and certainly what I would do, if my bank said interest rates are -5% now, every year your savings are going to take a 5% haircut. If my bank said that, obviously the first thing I'd do is move to a different bank. If all the banks said that because the Fed or the Bank of England or the European Central Bank had set rates at -5%, then clearly what I would do is I would withdraw as much cash as I could conceivably feel comfortable with. I'd probably invest in a damn good safe, and I'd stick as much physical cash as I could in it, because that earns 0. And 0 looks great if the interest rate is -5. That's a screaming bargain. So as long as physical cash exists, there's a limit to how low interest rates can go. So we used to think they couldn't go below 0 because people would withdraw lots of cash. It turns out they can go a bit below 0. So in Switzerland, they're -0.75%. In Europe, they're negative And people haven't withdrawn huge amounts of cash. There's been a bit of a pickup, but not a huge amount, primarily because actually there is a cost to storage. So you have you probably want, if you're going to store a huge amount, if you're going to store millions in cash, you're going to worry about fire, for example. You don't worry about your bank burning down, right? It doesn't matter if your bank burns down because your money's in a bank account. Yes. You really do worry if your warehouse full of dollar bills burns down. That matters a lot. So the cost to physical cash, to hoarding physical cash, you worry about theft, all of these sorts of things. So you can quantify that cost via insurance. But also convenience, that if you literally had, $2 million in physical banknotes, and you decide that you want to go and buy a load of shares instead, or you want to go and invest it in bonds or buy a new house, it's going to be really hard, right? You've got to hire some sort of physical security truck to drive it to the bank, arrange with the bank that you're going to pay in $2 million in physical cash. These sorts of things are quite hard to do. And, frankly, if you try and pay in more than $10,000 in physical cash, you're probably going to get quite a few questions asked and some funny looks. So there's some issues here with using physical cash that do allow rates to go a bit negative. Big study by the European Central Bank last year concluded they could probably go to -1. Not everyone agrees, and they haven't in fact gone that far negative. But clearly they can't go to -5. It's just impossible.
So I see this as, oh, sorry to interrupt, James, but I didn't mean to. I see this as foundational piece too, right? And I hadn't thought about it in this way. I think you framed it so well in the article that there's a convenience factor to a bank account, and there are costs to holding physical money. So there is some, 20 years ago, I would have never thought negative rates were a thing, but clearly they are. And Elon Musk even has talked about Tesla's bank accounts in Europe losing money month after month because of the negative rates. So the question then becomes, if you have a fully digital currency and physical money is kind of gone, how low can you go, right? And what are the impacts to the economy in terms of potentially managing inflation or deflation, or reviving a stagnant economy? That's kind of point 3 in this article, right?
Yeah. So the historically there's been this issue. I'll keep calling it the zero lower bound, even though, as has been demonstrated in Europe, it can go below zero, but it's, in Europe, the jargon is the effective lower bound. But this zero lower bound means that historically monetary policy has been kind of skewed. So you can raise rates as much as you want. So if inflation takes off, we saw under Volcker back in 1980, you really could raise rates to levels that people had thought were impossible. You can just jack them up, and that will kill inflation, kill the economy as well, but you can do that if you want to as a central bank. So monetary policy is unlimited on the upside, as it were, for slowing things down. But on the downside, it's got this limit. It can't go below zero. So you're skewed with what you can do with your interest rates. If you take away that below zero, you still can't go to an unlimited extent. At the extreme, you obviously can't have an interest rate of -100% because you just destroy all the money in the economy and the whole thing stops working, right? So there's clearly a lower limit. And at some level, long before that, people would stop holding money. I don't know where it is, but I can't imagine -50% interest rates, because you wouldn't hold money. People would move to gold. You wouldn't use checking accounts anymore. Things would just stop being usable. But you gain a whole bunch more flexibility. You can go further negative. Now, at the moment, I should just interject here, stepping back slightly, this isn't going to happen anytime soon. And the central banks all want to keep it quiet. So they all acknowledge this might happen, but they're not going to do it anytime soon, not least because if this happened early on in the introduction of central bank digital currencies, they wouldn't succeed because people wouldn't want them. People would say, well, if this is going to be what happens, we don't want to have them introduced. We want to keep physical cash. Thank you very much.
You're saying that, you're saying people would rebel against the concept because the digital currency would feel like a punishment in a way, and feel more, okay.
Yeah.
Thank you.
And I also think that even in the medium term, they're not going to go deeply negative because, again, culturally, socially, we just don't accept that, right? It's going to be really hard to get your head around. It was bad enough back in 2000 and I forget which year it was now, 16, 17, when negative rates came in, and the whole concept, everyone really struggled to get their head around the idea. But now in Europe, 5 years of negative rates, everyone understands it. It's sunk into the psyche. It's fine. The system operates. I mean, I say fine. It's not fine, but the system operates, and it hasn't caused any deep crises as yet. I don't particularly think you want negative rates for a very long time because I do think there are side effects. But chuck it forward 20 years and say we've no longer got physical cash. That seems to me plausible. You go forward 20 years, probably before that in many countries, but go forward 20 years. No longer got physical cash. It's not possible anymore. And you have a deep recession. So you then have a central bank that's already gone negative, so let's say Europe. People understand that in a deep recession, rates go negative, that's fine. Would they go to -1.5 instead of -0.5? I think absolutely. And then the next time, would they go -2.5 instead of -1.5? Well, if it had worked, I think society as a whole would accept that. So I think these things don't come overnight. You don't get, oh, the Fed's introduced a digital dollar and decided that rates are -5, right? It doesn't happen like that. It's going to have to be introduced, and we're going to have societal buy-in. But I can see how that could happen, let's say. I can't be sure it will happen, of course. You might not get societal buy-in. You might get Congress writing a law that says you can't have negative rates, for example. These things are possible. But I think certainly in places that already have negative rates, it's completely plausible to think that in a deep recession in 20 years' time, you get very negative rates. You go -5, -7, and that's quite important. And I do think it is at least plausible that happens in the States as well. Although, as I say, the States, we haven't even had small negative rates yet. So there's still much more societal resistance.
This is getting off of the article a little bit, but something that just came to mind is around parts of society that don't necessarily have alternatives of where they can put their money, like the lower income parts of society. I was thinking about negative interest rates, and if you have your money in whatever bank, with the Fed, there's negative interest rates there. They're trying to promote you. They're trying to push the idea that you can then be spending, like you have money elsewhere. But if you can't spend the money because you need it for life, are you kind of stuck in this odd place, right? Where having money in the bank doesn't work, having money outside the bank doesn't work. I'm just kind of playing with that intellectual, I guess, kind of thought experiment right now.
I mean, from an intellectual perspective, rather than a kind of how it actually feels like perspective, remember that nominal interest rates aren't really what matters. So what really matters if you're in that position is your buying power. And their interest rates are already deeply negative, right? So I mean, food prices are soaring. You're still earning 0 on your bank account or on your physical cash. What's the situation there? Well, you really haven't got any choice, right? I mean, if you're homeless and you operate in a cash economy, you when you go and buy food, it costs a lot more. And to the extent you have savings, which I'd suggest is not much of an extent if you're homeless, right? But to the extent you have any cash, every day it devalues a bit as food prices go up, or as rental goes up. If you're trying to stop being homeless, these are genuine public policy problems. But I don't think they're unique to the question of negative interest rates, because it's real interest rates after inflation that are what matters here, and they've been negative now for a very, very long time.
It gets back to your point around people in the streets if it happens too quickly. I think I picture all the images from the 1970s, right, of people in the streets around inflation at that time, and you're right, it's effectively the same, but psychologically it will feel different. Although, from the thought experiment perspective, it's the same.
And of course it's those people in the streets. I mean, well, not in the streets as such, but it's the strikes and the union power at the time that entrenched inflation, because if inflation's running at 10% and everyone demands a 10% pay rise to keep up, then inflation can't really fall, because those people are going to go and spend that extra 10% and probably push prices up even more, and then demand even more, and you get the wage price spiral. That is one of the reasons that the Fed ended up, jacking up rates and throwing a large number of people out of work. So you sort of have to be careful about, exactly how these things interact. But yes, I agree. It's, the people are tied to the nominal. People think in nominal terms, not in real terms. In at least in countries that haven't had recent hyperinflation. And if you think in nominal terms, it feels weird. It feels really weird to have negative interest rates, right? It's, just over the border, I'm in London at the moment, but just over the border in France, they have negative interest rates. But I still find it weird.
Yes. We've actually, and I do want to get back to the article, because I want to tie the interest rate change to potential bond prices, because I think that's a fascinating element. But on this point, we've been debating, you hear people on the show, we've been debating, you hear people make parallels to now, to the 70s. And it seems like there's not a Volcker in the U.S. government in any way. It doesn't seem like there's any appetite to consider raising rates if inflation runs out of control. Do you have any thoughts on those parallels, and maybe if it might be appropriate to consider raising rates in the near future for the U.S. government? Or,
well, I think at the moment the belief at the Fed is that this is transitory, and that you've got a bunch of things driving inflation which are temporary issues, so supply issues, primarily supply issues actually, but also the temporary boost in demand from the excess savings left over from the pandemic stimulus. And once those are worked out, the Fed thinks, and so do the markets, and so do almost all economists, that inflation will come back down towards its target. Now, there's a question about just how transitory things are, and I think the Fed is on the optimistic side of thinking that
yes,
we'll be back. I think their forecast is 2.1% for next year, and I suspect it'll be still above that. But nonetheless, it's not going to be running at a kind of annualized pace of 10% next year, unless something has gone very wrong. Now, there is a risk, of course. There's always a risk of this stuff, but if you raise rates when inflation is up because of a supply shock, you run the risk of making things even worse for people. The most recent example of that was 2012, when ECB raised rates, and of course that was followed by a very, very long recession. They raised rates then primarily because oil prices were up a lot, and they worried that would feed through into inflation expectations and into wage rises, and then become a self-fulfilling prophecy. The Fed thinks that what's going on at the moment still isn't really feeding through into widespread expectations that inflation will stay high. But I think if it did feed into that, if people came to believe that we were going to have, say, 5% inflation now, sort of permanently, instead of 2%, I think if the Fed thought that we'd all come to believe that, they'd be very worried, and they might well raise rates. Actually, that's one of the things that would push them. Certainly, they would be discussing raising rates. Whether they actually would, this depends where you sit on the conspiracy theory spectrum about the Fed. But certainly that would be deeply worrying. But at the moment, I can see why they're not. I think it's not obvious how raising rates would help, if you see what I mean. Like, you're not going to get more container shipping and therefore lower prices because you raised interest rates. So it would only be if you're worried about people coming to expect higher inflation and that becoming self-fulfilling. That's something that then raising rates would help. But at the moment, it's not obvious we've got that.
Yeah, I've read that expectations are a key aspect of inflation taking hold, and that's my worry at the moment. But the people at the Fed are better educated to attack this problem than I am.
Well, I wouldn't rely on them being right. and certainly not on. I mean, no one has a good way of measuring inflation expectations. There's lots of ways out there, but none of them are really any good. Not least because measuring inflation is itself a little bit of an art. But it doesn't seem that there's a widespread belief that this inflation is permanent. Let's put it like that. So it's at least plausible that the Fed is right, that it's transitory, even if a bit less transitory than they're arguing.
So then if we hop back into the article and tie together the end piece, which I also think is just such a fun thought experiment, you talk about a deeply negative interest rate environment relating to government-based digital currencies and the impact on bond prices. I think because you have a lower range in interest rates, the public could get, and correct me if I don't say this correctly, the public could have more faith that the central bank could navigate us through ups and downs of the economy, and therefore be more bullish on a quicker recovery, which could actually cause bond prices to go up.
Bond yields would, not bond prices.
Yes. Thank you. That's very good clarification.
Let's say economists rather than the public, but yes.
Okay.
The basic. So if you take a step back and say, well, how is a 10-year bond yield linked to the Fed interest rate? It's not, if you look at a chart of the two, it's not obvious that there's a very tight link, right? If anything, they move in opposite directions. But the logic goes that a 10-year bond yield is equivalent to 10 one-year bond yields over the period, and that it's that plus or minus some risk premium, because there's a risk if you've locked your money up for 10 years that things don't turn out as you expect. The risk premiums reflects, if one way of thinking about it is it reflects supply and demand, and the 10 one-year bond yields, or the 100 1/10 of a year bond yields, or whatever it is you choose to do, 3,650 one-day bond yields, reflect the fundamentals. The fundamentals in this case being the Fed, where the Fed sets interest rates. That's the main determinant that of the long-term bond yield. The risk premium can be quite significant, but it's kind of within a percentage point up or down, let's say, over that, added on to the top of what that average is over the period. And that average over the period, really, if you think about where the Fed rate is going to be, that should be determining where the bond yield sits. Mm-hmm. So if you think of that as your basic model for bond yields, you then say, well, what makes the Fed rate go up and down? Well, if the Fed raises rates, what happens? Well, a basic economic model is that the economy is slower than it otherwise would have been. People borrow less and save more, so you don't get the big economic boom you might have had. You might still get an economic boom, but not as big as it would have been. So if you think that the Fed is going to raise rates, should you buy or sell future bond yield, 10-year bonds? Well, it's not immediately obvious. So if they raise, say I told you that tomorrow the Fed was going to raise rates to 5%, right? You'd be obviously, the first thing you'd do is dismiss it as nonsense, because that clearly isn't going to happen. But if it did happen, it would almost certainly plunge the economy into a deep recession. And you would then expect that, well, what's going to happen? Well, the Fed's going to cut rates, right? The economy is in a deep recession. It's going to be under huge pressure politically and everything else to cut rates. And that probably bond yields are going to fall, because that's what bond yields do in a deep recession, because people expect the Fed to cut rates. So the bond yield is really a sort of future on the Fed funds rate. And if we're expecting that the rate will be cut, then bond yields should go down. Now, obviously, if we're expecting that the rate will be cut, normally you look at the 10-year, because it sort of abstracts away from any given rate move, because it's a long, over the cycle move. But if we're talking about negative rates, we've suddenly got a really interesting thing, because we don't know, does it make bond yields go up or down? Well, it means that on average, if again, we think about the average, so on average, at the moment, bond yields pretty much have to be positive. Certainly the Fed funds rate has to be positive, right? Again, there's that risk premium I talked about. You just about could imagine a 10-year bond going negative, but it's quite hard. But certainly the lowest you'd expect the Fed funds to be over the next 10 years is zero. Yeah. So
Yeah.
if I said, well, actually, the Fed funds can now go negative because that's possible, the immediate mathematical response is, well, that means that on average, I would expect, not knowing the future, not knowing what's going to happen, but on average, that's going to be lower. That average is going to be lower now because previously it had to stop at zero. Now it could go to -2, right? So on average, I should expect it'll be a bit lower without any information about the future, without knowing what's going to happen to the economy, without projecting anything. I just think, well, sometimes it will go negative, whereas in the past it wouldn't have gone negative. Therefore, it's going to be lower in the future. But then you come to the secondary effect, which is, well, if it's negative, and if you believe negative rates work, that should boost the economy, which means they'll get back to positive again and get back to higher positive more quickly. So rather than being stuck at zero for 6 years, maybe they go to -3 for a year and then back up to 2 for the rest of the time. So on average, your rate is actually higher than it was before. And so then you get into the question, well, do we believe that negative rate interest rates work? And that's a much more difficult economic question, right? And frankly, it's an ideological question primarily if you look at the divide of people. But if you believe that negative interest rates do work and that deeply negative rates will work, then that going to -5 might stimulate the economy more quickly. So you spend less time in recession, less time at zero, and more time at a higher rate. So on average, your rate ends up being higher because of this flexibility to go lower, which is mathematically weird, but because of the feedback loop into the economy. And then you say, well, in that case, bond yields should go up. And of course, this matters now. The reason this moves from being, an academic discussion on a podcast to being real world investment is that in the 30-year bond, if we go back to where we started, well, over the next 30 years, we'll probably have a digital dollar.
Exactly.
We might well have no more physical cash, and therefore the Fed might easily be able to go negative. So if we think, well, in 25 years time, interest rates are going to be -5, that makes quite a difference to, it's only a small difference on a 30-year bond, but it does make a difference to a 30-year bond compared with if we think they're going to be at zero. And we kind of need a view. Does that help the economy or not?
You articulated that perfectly. James, I know we're close to time. We have 2 questions, and Douglas might have another question for you. We have 2 questions that we ask all the guests on the show. Do you have a few more minutes to stick around?
One thing that came to mind, this gets back to the psychology aspect, as you were talking a little bit, and also thinking about the Fed's responsibility, which is primarily to the economy, right? You think about employment as well as inflation. However, if you think about where the markets are, one thing I think that's fascinating is TINA, right? There is no alternative right now. And what TINA has, at least in my view, I don't think this is a rocket science view, but in my view, TINA has led to so much risk taking right now that the longer that the interest rate right now stays low, because you were discussing how raising interest rates right now, it could be detrimental to the economy. I'm also thinking that the longer it stays low, the more people can say we're not in a bubble, right? There are certain folks that are saying we're not in a bubble. However, we're in some version of a bubble. I think you wrote an article, I can't remember the exact title, but if it swims like a bubble and it looks like a bubble, something like that, right? And the longer you keep those rates low, the more risk taking, I think, on both the corporate side as well as in the individual side, I can see us taking. The more corporate debt we have, such that when interest rates do go up, which they will happen eventually, I imagine, the more debt people have and more debt companies have, it seems like we might be building up just a bubble that it's too big to fail, right? But almost too big that it can't, right? At the same time. And so thinking about the difference between protecting the economy from rising interest rates right now and protecting the market to protect the economy from rising interest rates right now is the basis of that question thought.
So it gets into a very deep problem that, central bankers and economists only really started to grapple with after 2009, after the catastrophe, because there's a school of thought that had picked it up earlier, which had been sort of widely sidelined, which is Minsky, essentially. And 2007, 2008, you had this Minsky moment where it turned out that all the debt that had built up during an era when interest rates had been relatively low came back to bite you. And Minsky's insight was that the longer you have cheap money, the higher the risk people take. And of course, the more risk people take, eventually it goes wrong. And whilst that is undoubtedly true and insight into human nature and the nature of markets, the problem, of course, is to say when and how much is too much. And the answer is we don't know on either of those situations. And there's frankly, too long to do as we approach the end of the podcast, but there's a huge debate about whether central banks should be in the business. When you go back to 99, should central banks be in the business of popping bubbles, or should they be in the business of cleaning up the mess afterwards? And that debate was live in 1929, in 2009, in 1999, and probably lots of other times as well. That even if they successfully spot the bubble, it's not obvious whether they should step in to stop it or not. And it's there's genuine political and economic questions and monetary questions here that just don't have a simple answer. And some people think that they have a very strong view one way or the other, but mostly it's because they're ignoring all the counter arguments. It's just not simple. It comes back. I think at heart it comes back to politics. Are you ready to accept unemployment in order to prevent a bubble? And I think you'd be hard pressed to find any politicians who are. That's my general view. But yeah, the alternative, of course, says, well, it's no business of the central bank. And what if they get it wrong? Maybe they think it's a bubble, but in fact the markets are up a lot because of technological innovation and structural market shifts and things like that. Well, if they did that, that's a problem too. And then the secondary argument says, well, is it do you really want monetary policy set according to what the market does? Ideally not. But the problem is then you get the difficulty of, well, in fact, that's exactly how monetary policy does work, right? It's all intermediated by markets. That's how it affects the economy in the first place. So there's all sorts of really difficult questions that probably a little bit long to get into right now, but they're very interesting.
Yeah, Minsky's come up a few times this podcast for that very purpose. Thank you for that. So for the last two questions, I'll throw out one, and Skippy, feel free to throw out the other one. How do you invest your personal finances?
Well, we can't. As a journalist, I can't just buy and sell. We have some pretty strict rules. So I'm all in broad funds and mostly on regular monthly purchases. I sadly can't do dramatic shifts in my portfolio, except every now and again I could sell and go to cash, I guess. But I tend not to do very much. The only two I generally think I am best at spotting very extreme moments. I think the best opportunity to be right against the market is to spot very extreme sentiment. So last year in March, I thought things were way overdone. Everyone was far too bearish at the bottom, and I wrote a big piece saying everyone's scared, it's time to buy, which is a fairly straightforward approach. And I obviously can't do anything until after I've written it. I can't front run my own articles, but I did then go and add some to my portfolio. And the other two times were in 2007 and in 1998. In 98, when I was a very junior journalist and not really covered by any of this because I wasn't doing anything in Asia, I went and bought as much as I could, which a sum of money now insignificant, but it matched a lot to me then, in a leveraged Asian fund, which worked out beautifully because I timed it again purely on sentiment without knowing anything about what was going on really in Asia at the time beyond what I read in the papers. Just on sentiment, I timed it nicely. And again in 2007, I was at the time covering hedge funds and had a fairly good insight when everything blew up in subprime. That summer I decided, so a bit after it started to blow up in subprime, but that summer when the market just carried on up, and I just thought, this is madness. Markets ignoring the obvious. Now I wouldn't in any way claim I knew what was going to happen and how awful it was going to be, of course, but I did dump my portfolio. But it's very rare that I do anything. Most of the time it's on automatic because I obviously can't trade individual stocks, and I don't mostly think I can time the market well enough to do, big moves that I'm going to then have to stick with for quite a long period of time. I can't try and time little ups and downs.
Thanks, James. The reason we ask that is some people, definitely not you, but some people maybe write or say things that differ from how they actually invest their personal finances, and we just like to cut straight to the chase and say, what's your approach?
Sometimes I'm really quite bearish, but it's very rare that I'm so bearish that I want to actually dump my whole portfolio, and there's not a lot I can do around the edges, so I can't sort of cut back small amounts or add small amounts. I suppose I could stop monthly investing, but my administrative capabilities are so weak that from a sort of execution point of view, the chances are that if I did that, I would forget to turn it back on again, or I would turn off too much or lose the password or whatever it is. So there's a reason I'm not running any sort of, quite aside from my views on things, I would be hopeless running any sort of fund because I'd never be able to execute when I really wanted to.
Yeah, so we are so appreciative of you coming on the show. We always wrap with this, which is hopefully a fun question. We like to ask people about their dream retirement and how that differs from their life today.
Dream retirement. I haven't really thought about it. I guess I'd like to keep doing something part-time, something active, involvement in something, whether it's writing or in business somehow. And probably the rest of the time would be on a rock, climbing on a rock by a beach. There's some particularly good rocks by beaches in Thailand, but there's plenty in other parts of the world. And yeah, if I could get onto those, I'm hoping I'll be able to retire while my before arthritis kicks in so badly that I can't climb. That's great.
That's awesome. We are both based in Colorado in the U.S. So if you're ever out here rock climbing, give us a holler.
Yeah, good place to be. I see the bag in the background there. It's obviously ready to hit the hills at any moment.
Exactly. Yeah, there's good climbing 10 minutes away from my place. So. Well, James, thank you so much. I really appreciate you taking the time. We both do. And we just love your stuff. So this article specifically was great, but everything is great. And your insights, I really enjoyed. Thank you for taking the time.
Cool. Well, I've enjoyed the conversation. Thank you.